And once each staff member is in their designated room, please start the recording.
Fantastic. Thank you, Leslie. I'll give everybody just 30 more seconds to find their appropriate interpretation room before we jump in. All right. As Leslie reminded us, tonight's session will be recorded, so just give a few more seconds while we get that situated. But good evening, everybody. Thank you so much for being here tonight for tonight's tax webinar for childcare providers. I'm Chris Baharias. I'm the Director of Early Care and Education in our Western region here at the Low Income Investment Fund. LIIF, or the Low Income Investment Fund, has been a leading community development financial institution since 1984, committed to supporting and uplifting communities across the United States. LIIF has been LIIF's Early Care and Education team seeks to support childcare providers and the development of childcare facilities that promote the health, well-being, and sustainability of the children, families, and communities that we serve. Before we jump in and get started, I just want to review some logistics about tonight's learning event. As we reminded each other earlier, interpretation will be available in both Spanish and Chinese. If you haven't done so yet, please navigate to the room of your choice using the globe at the bottom of your screen. Tonight's webinar will be recorded, and while a copy of tonight's slides will not be shared, a copy of the recording as well as a helpful tax resource document will be shared to the email used to register for tonight. Lastly, please remember to use the Q&A function at the bottom of your screen to enter any and all tax-related questions that you have. While some of your questions will be answered in that chat, we will absolutely reserve time at the end to review. And with that, I'm excited to pass the mic over to Jennifer Vale and her team at Civitas Strategies, who LIIF is partnering with to put on tonight's webinar. So Jennifer, over to you.
Thanks, Chris. Thank you so much. Well, good afternoon, good evening. Thank you so much for joining us here. We're very proud to have been invited by LIIF to discuss tax preparation strategies for childcare businesses this evening. So I'm Jen Vale. I'm an Associate Director with Civitas Strategies. And at Civitas Strategies, we work with childcare providers such as yourselves and the organizations that serve you to help you have flourishing, sustainable businesses. This is the perfect time to be discussing taxes. It's great that you've joined us this evening. We're going to discuss the strategies that you can implement to make tax time beneficial for now, as well as throughout the year. We want to make tax time as stress-free as possible for you. So let's take a look at this important topic. Before we get started, just would like to remind everybody that this presentation is for educational purposes and it is not to be taken as legal or tax advice. The information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information are not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited, and only non-commercial use of this work is permitted. All right, so today we are going to cover several important tax topics to help you run your childcare business smoothly year-round, not just during tax season. So the processes and the strategies that we'll discuss tonight will be helpful as you run your business successfully through 2024, as well as into the years to come. So this is a good investment of your time. So what will we go over today? Well, first, we're going to discuss why you should care about your taxes throughout the year, not just up until April 15th. After that, we're going to explain what a Schedule C is and how you'll use it to report your home-based childcare business's income and expenses. We do have some California-specific information tonight that we will share with you throughout the presentation. We will also go over some of the steps that you'll take now to get organized and prepare for tax filing for this year. And we're going to basically allow you to think about the future and what can help you a great deal in the years to come. So hopefully today we have some practices that we're going to continue for quite some years. And the goal today is to provide you with tax knowledge, to optimize your filing and minimize headaches when tax season rolls around. All right, so why should you care about your taxes? Well, knowing how to effectively address taxes can help you with several different things. One is profit retention. So it's the responsibility of every business to pay their fair share of taxes. Proper tax preparation can be a vehicle to help you recapture your hard-earned profit, and it helps you keep more money in your pocket. So understanding allowable expenses, what it does is it allows you to legitimately pay less taxes and retain more profit. Another reason that you should care about your taxes is risk mitigation. So education is key when it comes to understanding allowable expenses and to properly prepare your taxes. The more you are aware of the tax rules as they apply to childcare businesses, the less likely you are to trigger an audit. So audits can be very time consuming, they can cause distress, and at the end of the process, they may prove to be very costly. An audit will almost always result in you owing money, and you may not be prepared to pay that. So we want to care about our taxes for that reason. One of my favorites is actually understanding your business's health. So reviewing your taxes is a fantastic way to evaluate the health of your business. Having an accurate account of your profit really allows you to understand the financial position your business is in, and it can help you plan for changes going into the future. And then building business confidence. So, knowledge is key, and having confidence in knowing that you have properly claimed deductions and have met your tax obligations, it removes a factor of the unknown. Understanding your taxes gives you the ability to continue to operate with the mindset that you are following the rules set by the IRS and are unlikely to have any foreseen debt and potential future problems. So a lot of great reasons to care about your taxes. All right. Well, Civitas Strategies has been actively involved in working with child care providers regarding issues that surround taxes for several years now. And we wanted to make sure that our efforts addressed what is most important to child care businesses. So we wanted to learn about how our child care businesses that we work with go about filing their taxes, and we undertook a project to review the tax returns of child care businesses to see where opportunities for improvements lay. So our research on the past, or basically past research with these true tax returns illuminates several findings. So this we found with child care providers that we work with every day. So these were businesses that we were very familiar with, and some of these findings were quite surprising. So out of our group that we surveyed, 83% of home-based child care providers did not claim the business use of their home at all. That's very, very surprising. So the IRS allows these deductions on Schedule C for business use of home. You can take those deductions associated with the cost, but we found that 83% of the providers that we worked with on this survey did not claim those expenses. Now, as a home-based child care provider, you have the advantage to be able to deduct business-related expenses that may be shared by the business use of your home and the personal use of your home, right? So you're able to work with those business expenses, even though you're operating your business out of your home. So we were really concerned to find that many providers did not take business use of home expenses. So that was concerning. And then this was another shocker for us. So in some cases, providers did not claim any expenses on their tax returns at all. Now, that, as we know, that should never happen, right? Every dollar is important to reinvest into your child care program. And undoubtedly, child care providers have deductible expenses required to operate, right? So there should never be an instance where a provider is unable to find or claim expenses that are associated with their child care operation. So the IRS Schedule C has many expense categories under which deductions can fall. Even if somebody else prepared your taxes, we are going to encourage you to review each category to identify qualifying expenses so that you can lower your tax liability. So even if somebody else is preparing your taxes, it's really important to know, especially about the Schedule C if you're a home-based childcare provider. Now, by understanding all of the allowable expenses, your business can help you mitigate all the expenses that your business can take can help you mitigate tax liability and retain more profit. So another finding that we uncovered was that many providers were claiming invalid business expenses, and that dramatically increases their chances of an expensive, time-consuming IRS audit. So while we are absolutely advocating claiming valid business expenses, the key word there is valid, right? So not all expenses that are incurred are always a valid childcare business expense. And this is especially true, right, if you're a home-based provider, because you're sharing the home with your business, and there will be expenses that you have that are only related to your home and not your business. So it is a fact that when some expenses are included on taxes, they can automatically trigger audits. So I want you to keep this rule of thumb in mind. The IRS considers a valid deduction to be ordinary and necessary, required for operating your business. So that's what they're looking for in regards to business expenses. So, it's very obvious that there are expenses that are needed to operate your business, but you always want to keep in mind that question: is this expense necessary to run my business? And that's something, the rule of thumb, you can use that to judge whether you have an allowable expense. So one of the interesting things is that the IRS actually evaluates if expenses are appropriate based on your business type. So the IRS is very, very aware of what types of expenses are appropriate for childcare businesses. So expenses that could potentially be allowed in one type of business may not be allowable in another. So keep in mind that the IRS, as a childcare business, the IRS is paying attention to the types of expenses that you take, making sure that they are aligned with proper childcare business operations on there. And something else that we found is that several common deductions were often miscategorized or improperly calculated. And when this happens, that can raise an automatic audit alert, even if the deduction was valid, right? So just being in the wrong place on that Schedule C or on any tax form could potentially raise a red flag and cause an audit to be triggered there. An example that we like to give that we've found quite often is children's meals, right? So it's found that many childcare providers were deducting children's meals on the line on the Schedule C that says deductible business meals. But the IRS intends that line to be used when you are having business meals while traveling, not children's meals, right? So not the food that you're providing the children every single day. So having an expense in the wrong place, right, the wrong category, could prompt an audit, even if it's unintentional. So, just putting things in the right place, very, very, very crucial. So now we know that there are a number of tax forms, right? Lots of different tax forms. And what I'd like to do is let's discuss the Schedule C. So keep in mind, even if someone else is filing your taxes, there are elements of tax filing that you, as an educated business owner, will want to understand and be knowledgeable about. The Schedule C is one of those documents. So income for sole proprietorship is reported on the Schedule C form as part of your personal 1040 tax return. If you're a single member LLC deciding to not be taxed as a corporation, you'll also file your personal tax return and the Schedule C. If you're an LLC choosing to file as an S Corp or a C Corp, your business filing, tax filing, is not associated with your personal 1040 return. there. An interesting thing about Schedule Cs is that if you happen to have more than one business and they're not closely related, then you actually may need, or you will need, more than one Schedule C. So an example would be if you have a business on Etsy, in addition to your childcare business, and maybe you also drive for Uber or for Lyft, those would be separate Schedule C forms. So you do want to keep in mind that different businesses would require separate Schedule Cs. And we're going to take a look at a Schedule C in just a moment, but basically, the bottom line is with a Schedule C, first you report your revenue, right? All the money that you receive for your business. Then you show all of those expenses, right? Which are the things that you paid for to keep your business running smoothly. And then you calculate the amount that remains. And if it's positive, you made a profit. And if it's negative, you had a loss. Really, really straightforward. Let's take a look at that Schedule C. All right. So you just want to be very familiar with the different sections of the Schedule C. Now, if you happen to use tax software, basically the tax software asks you questions that align with these different sections on the Schedule C. I'm going to say that even if you're using tax software, you'll want to take a look at a Schedule C. You'll want to be familiar with it. Again, right, knowledge is key. The taxes and knowledge hand in hand. So even if somebody else is preparing your taxes, or if you're preparing your taxes using TurboTax or any type of tax software, understand your Schedule C. Really take a look at that. Understand the tax forms that relate to your business, not just the Schedule C. But when we look at that here in the pink, you'll see that that's part one, right? And that's where your sales are all totaled. There is a line there for cost of goods reported. We put all of our sales there to show our gross profit. I just like to mention that the cost of goods on the Schedule C actually really does refer to the cost of the sale of products rather than services. So it's very rare that a childcare business will actually have something under cost of goods. So don't be surprised if you've gathered all your revenue and you're showing that right there as the gross income and then not showing anything under cost of goods sold. So don't,
Jennifer, can we slow down just a little bit, please?
Oh, sure. I'm sorry. Should I repeat anything or we're okay? Oh,
I think we're okay.
Okay, great. Thank you. Yep, we'll slow it down. It's my New York. I just keep going. All right. So on the Schedule C, part 2 is where all of your business expenses are reported. So that's the section in green that you see on your screen there. So you want to be very well acquainted with that section of expenses because there are over a dozen categories that are listed to help you stay organized. There are expense categories such as advertising, car and truck expenses, legal and professional services, rent, travel and meal expenses, and other costs. So keep in mind that those allowable expenses are what basically reduces the bottom line. It reduces your tax liability, right? Lowers the amount of taxes that you have to pay. So accurately including all of your allowable expenses is very much key when filling out the Schedule C. So you want to keep that in mind. And then at the very, very bottom, that last section is where your net profit is calculated. That's line 31 of your Schedule C. Very simple, right? We're going to take our net profit that we've calculated. We're going to expense all of those. We're going to add all of those expenses that we came up with in part 2. And that basically will give us our net profit, right? We're going to take all of our revenue, we're going to subtract all of our expenses, and it's going to result in our net profit. Keep in mind, the net profit is what is considered to be your income from self-employment, right? So if you're familiar with taxes, you know that that's where that number is what your self-employment taxes are based on. So we do want to be able on the Schedule C to go about utilizing and finding all allowable, right? We said valid expenses, but we want to use the Schedule C has a lot of great information shown there that can help perhaps trigger an idea that you may have about an expense that you forgot about, right? So going over the Schedule C may help you remember some expenses that you hadn't thought about in a little while. All right, so let's switch gears. We've looked at the Schedule C, so let's discuss how you can proactively prepare for tax season to avoid headaches down the road, and a proper preparation is the key to helping you tackle tax time like a pro. So how do we prepare for tax season? All right. I'm going to now get very excited about something tax related. So when it comes to tax preparation, I'd like to share with you one of the most comprehensive tools to address childcare taxes, and that is the Homegrown Preparing for Tax Season, a guide for home-based childcare providers. I find that the name is a little bit of a misnomer because the guide has an excellent selection on expenses, and I think that even small centers could benefit from the information that's contained in this guide. So the guide, we'll go over, I'll just share with you what it contains, because the organization Homegrown aims to help home-based childcare providers optimize their tax preparation process and maximize deductions. So Homegrown has this in mind as they've created this guide. Here are not all, but so many of the topics that this guide covers. So record keeping best practices that you would implement now, tracking income, expenses, mileage, business use of your home. It helps you understand the Schedule C. So again, where you're capturing that income and different kinds of business expenses. It's great in that it shows how the business use of home deduction works, which includes calculating and documenting time space percentage, which a lot of home-based childcare providers get either a little confused about or may not know as much about it as they should. So there's an excellent section in there on the time space. It can help with maximizing write-offs for eligible deductions on supplies, meals, utilities, repairs, insurance, and more. There's a section as well as, and we'll show you a little bit of a spreadsheet there, but there's a section that has a spreadsheet that has a tab for tracking and claiming your automobile mileage for business travel. So it has an area to help you with that. There's a section on here that discusses depreciating
Madam Clerk,
assets. Like,
Are we supposed to move forward on the slides?
no, not yet. What slide are we on? I'm sorry. The homegrown slide?
Yes.
Yeah, so we're still on the slide that has the QR code for, as it says, critical tool preparing for tax season.
Perfect, thank you.
Okay, yep, we're just going through all of the things that are included in there. So sorry, we're just kind of giving you a little background on what's included there. So many things as we were saying, right? Depreciation is covered in there. Depreciation is something that often throws folks off. Taking advantage of the qualified business income pass-through deduction, that's discussed. Helping you choose the right business structure, that is something that a lot of businesses are concerned about. Sole proprietorship versus becoming an LLC. The Homegrown Guide will help you with that. And there are some really nice proactive tax planning steps that you'll take this year to help you with next year, right? So the guide will help you with 2023 taxes, and it also then will help you going into the future. And can't say enough about it, right? That it contains checklists, guides, visual examples that walk you through every step to support home-based childcare providers in preparing for tax season. There are actionable steps, so nothing is better than when we have a tool that actually gives us steps that we can follow with the tax practice. So that makes tax time easier, and it can help you save some money. So they do update the tax guide annually, and the 2023 version is up now. So we do have a QR code here, and the link will also be dropped in the chat. But if you'd like, the slide's been up for a little while, but if you have a chance to take your phone out, You can use the QR code and go right to this free tool. All right, so when it comes to taxes, the truth is simple, right? It's understanding about what you made and what you spent. So first, let's discuss how much money that you made. So the first section of your taxes is all about revenue, right? So how much money you made. Getting that information can be very easy if you have an accounting system, right? You're collecting that information throughout the year. But if you don't use an accounting system, there's no worries. So in the, we'll show you next, in the homegrown guide, there's a revenue worksheet that you can use to calculate your revenue if you're not using any type of accounting software. And I'll show, there's a link that I'll share with you for the worksheet next. We have a little QR code for that. So when we want to figure out how much money did we make, the first thing that we do is we gather all of the records, okay? So there are usually 3 types of records that you're going to have for your revenue. Now, the first, 1099 forms, right? So these are evidence that another business paid you for services. Many home-based childcare providers will receive a 1099 NEC, and that would be for subsidy care payments, and for any participation that you have in the Child and Adult Care Food Program, right, the CACFP. Now, throughout 2023, you may have heard that if you receive $600 or more in payments through payment apps like Venmo, that you would receive a 1099-K for the 2023 tax year. Well, in November, the IRS decided not to enact that rule for 2023. So actually in 2023, you'll only receive a 1099-K form for payment apps if you had payments that exceeded $20,000 and had more than 200 transactions. So that rule that we were all anticipating and believing that we were going to be getting the 1099-Ks, that's been put off a little bit unless you hit that $20,000 and 200 transactions that would no longer apply. We're not, that $600 doesn't apply for 2023. In 2024, we know that that threshold is going to change to payments exceeding $5,000. And I'm going to recommend that in the coming years, listen for any type of announcement to see if that $5,000 threshold continues to be carried on. We do expect that that will change and perhaps will be lessened. Maybe we'll get to the point of that $600. But we have no way of knowing, right, if that's the case. So while we're not receiving those 1099-Ks, perhaps not receiving those 1099-Ks, remember any income that you receive through a payment app, you must report as income. You must report it as revenue. So even if you don't receive a 1099-K, you're going to add that to the amount of your revenue for the year. Now, what's another way that we can find our revenue? Pulling out our bank records, right? Let's grab our bank records and let's look for any additional funds that we received from other sources. Let's take a look there. So we would go through our bank statements month by month, looking for deposits that we made for revenue that was incoming. And in a lot of instances, you'll rely on your own documents, right? So those could be the portion of the receipt that you keep when a parent pays you. You give them their receipt, you keep a stub or electronic stub, so to speak, right? That you have some type of record of your own that shows that parents paid for care. So we're going to gather all of that information together. All right, so we've gathered everything together. What are we going to do? Well, if we have that accounting software, we're going to make sure that everything has been input into the accounting software. If we don't, we can use a revenue sheet. And I do have the QR code here. The link will be in the chat. This happens to be a Google sheet. It has tabs for revenue expenses that are 100% deductible. It has a tab for home expenses that you have to take the time space calculation into consideration. And it also has a tab for mileage logs. So please feel free to use the QR code to access the digital version of this revenue worksheet there. Super, super easy to use. You'll be able to list every 1099 that you've received for each child that you've served. You'll be able to list other income, including grants, right? We did in 2023, many businesses still did receive some stabilization, either some federal or state funding. So keep in mind, if you did receive grants, you are going to be including that as income, as revenue. So you may have some revenue that are not accounted for on 1099s. Now, if you receive reimbursement through the Child and Adult Care Food Program, basically you are still going to report all of that as revenue on the Schedule C using that 1099 that you received, right? But the thing about you've received this 1099 for income, but you're still going to take those food expenses as allowable deductions. So don't be off-put by the fact that you received a 1099 for the CACFP program, because you're also going to be taking all of those deductions for the cost of food. So, all right. What's the next thing we do? We looked at what you made. Now let's look at how much you spent. So you're going to collect all of your expenses. So it's obviously what you spent money on for your business in 2023. What you need to do is make sure that you have records of all of your costs. Basically, you would ideally have receipts that show payments for all of the exceptions. But if you don't have receipts, you could use canceled checks. You could use invoices, credit card statements, bank records. But it is critical that any expense that you have that record for, that it shows that you've recorded that you paid the expense. We want proof that we paid the expense. We want the amount that we paid, the date that we paid it, and a description of the item purchased or the service received. So in theory, all of that information should be on every piece of documentation that you have for an expense. So again, in the homegrown guide, there is a tab for mileage, right? So mileage is an expense that you can take that you're keeping track in most instances of the mileage, or you can also track the actual mileage and expenses or mileage rate. Simple log, that would be something that would be proof of your mileage expense, and you'd want to go ahead and make sure that you have that properly documented. So we've gotten all those receipts together. We are going to go through our credit card bills. We're going to look and see, did we pay anything through any of the cash app, any of the payment systems, app payment systems like Venmo, Zelle, PayPal? Did we have anything that was outgoing that we paid as a business expense through? Sometimes we receive money through those payment apps, but sometimes we also pay expenses through them. So what you want to do is take a look at those, look at your bank statements, your checks, get everything together, because every expense counts, every allowable expense now counts. So if we've gathered all those receipts and we don't have accounting software, this is where you could go back to that digital worksheet that we shared we had the QR code and shared the link, because there's a tab on there for expenses. And what's nice about this is a page that we're showing here. It's basically walks you through all of the expenses. And I feel like not only can home child care businesses benefit from this, but so can corporate and partnership businesses. There's a lot of information here that could be shared. So this is basically, in that table, you're also going to find a tab that will allow you to record the home expenses that are related to the business, and also, the business expenses that are 100% related to the business, and also the home expenses that are shared between home and business. So here's another definition that I'd like you to keep in mind when it comes to expenses. So Direct expenses is what the IRS refers to, and that is an expense that is incurred exclusively for the business and provides no personal benefit, right? So we know that some examples of a direct expense in your home would be, let's say you're fixing a bathroom that's only used by the children in your care. You're getting a new children's rug for an area that only the children play in. Playground equipment that are only used by the children in your care. Those are direct costs, 100% of the expense, but you also can have indirect costs, right, that are associated with your home. Things like homeowners insurance, utility bills, basically those are the types of things that are included in the business use of home. So we're going to take a look at, you'll gather all of that information there, and you'll want to hold on to the proof of payment for at least 4 years. So through this tax season and into 4 years, we want to keep all of the documentation surrounding our taxes there. Now, it's great if you can also, in addition to any paper receipts or documentation that you can also have electronic documentation. It could be as simple as just snapping a picture of a receipt with your phone. Just take a picture of a receipt, put that in a folder and maybe in the notes section of your phone or something. It's very helpful and a smart business practice if you are keeping 2 sets of records, if you're just making sure that you've covered yourself and that all of your receipts and your documentation in general, that you have it in 2 safe places. So something to consider there. So when it comes to expenses on our taxes, there actually are a few categories that are considered to be tricky topics, right? Those topics can often cause issues when you file your tax returns. And they're vehicle expenses, food expenses, home expenses, and stimulus funding. So those are things that are considered to be tricky. We'll start with the vehicle expense, all right? So let's start with transportation. So there are some very specific rules and regulations, like any deduction, that you need to follow. So here are all of the elements on the screen that you'll see. You need to make sure that your transportation costs, expenses, meet all of these in order to be deductible, all right? It has to be in the regular course of doing your business, directly related to your child's care. An example of that would be going to pick up the children, right? It could be business related, like going to Costco to get milk for the childcare business there. What happens with travel and transportation expenses is you always need to keep personal and business travel separate in your records. So let's keep that in mind there. So here, how can we, what can we look at when it comes to business trips? What is the primary rule? The primary rule is that a trip can be for both personal and business purposes, but it's only deductible if the primary purpose of the trip was for business. So let's, kind of keep that in mind. An example would be if you're going to Costco and you're purchasing a long list of supplies for your child care center, and you pick up a personal item. Somebody in your house wants a jar of pickles. Okay, that trip would still be deductible because the business portion was the main reason for going, right? We went to Costco to get all of these supplies for our child care center. The fact that we got a jar of pickles doesn't make that any less a business expense. But if you were going to the grocery store for your own groceries and you're there and you happen to pick up an item that's needed for your child care business, that trip would not be a deductible trip because your personal errands were the primary reason that you took that trip. So you'll want to keep that in mind. So the key for deductible expenses when it comes to transportation is, why was the trip necessary in the first place? If the main purpose of that trip is business, it's a deductible trip, even if a few personal items were purchased. But if the priority of that trip was personal, with just a little bit of an incidental business purchase or a little bit of a business element, it doesn't qualify as a business expense. So, and what we want to do is we want to understand that there are are how do we deduct those transportation costs? And if you use a vehicle to conduct any business for your child's care business, how do you deduct the transportation costs? There are two ways that you can deduct your vehicle expenses. One is called the standard mileage rate, and one is the actual expense method. All right, so the actual expense method captures all of the costs associated with your vehicle, but it does require extensive documentation, which means you have to keep every receipt that involves your vehicle. You have to log mileage for both personal and business use. So the pro of having this type of method is that it can result in a higher deduction, right? Especially if your vehicle is used primarily for work. There's a lot to be said for receiving, being able to take expenses for the actual expense of a vehicle. So keep that in mind. But a con is that it does require significant amount of time to collect, retain all the receipts, retain the mileage logs. So the actual expense method, it can result in a larger write-off, but it does demand very careful record keeping to track both the business and the personal use, plus proof of payment for all vehicle costs. So just keep that in mind when you think about the actual expense. Now, another way that one of the only two ways that you can expense transportation is the IRS mileage rate. I'm going to call something to attention. I didn't realize this. The mileage rate that's listed here on the screen is actually for 2022. I apologize. The mileage rate for 2023 is 65.5 cents per mile under the IRS mileage rate. You can find that on the IRS website. It's very, very easy to find. So if going into the future, because that standard mileage rate often changes, you'll want to be aware, keep up, if we're going into 2024 tax season, you'll want to keep aware of that. So the IRS standard mileage rate really does simplify the deduction, because you are just tracking it's a detail log, but you're tracking the business miles driven. So business miles, right? What's a pro of that? Much easier to calculate, fewer records to collect. You're only tracking business miles, not personal miles. And you're multiplying those business miles by the mileage rate, the standard IRS mileage rate. Now, a con is that it's limited to that fixed rate set by the IRS. And it's kind of interesting that your records could technically, from the IRS, get greater scrutiny. That's why you want to be very, very thorough in keeping the log with all of the business mileage. One other thing about these is do not jump back and forth between these methods. You choose a method and you use it going forward. You will not want to switch the IRS does not allow you to continually switch what type of method you use to calculate your transportation costs. So regardless of whether it's the actual expense or standard mileage, you still need to keep a log of some type, that notes the date of the trip, the distance traveled, the location you were going to, the purpose for each trip. Remember, when we talk about actual, we've got to do that for both business and personal, right? Seems a little odd, but we do. When we're talking about the standard mileage rate, there's less documentation, but you are still keeping a log, right? You still need to keep that information so that you know how many miles were driven, and you want to be able to justify that it was a business trip. You'll want to compare the effort that it's going to take for each of those methods. So taking a look at which one really works best. I've referred to mileage logs a few times. I referred to the tab for mileage log in the Homegrown workbook. There are many, many apps that make it really much easier to track mileage. So I certainly encourage you, if in either instance, whether it be the actual expense method or the standard IRS mileage rate, look into some apps, because it can make your life a lot easier and basically more accurate. So those are always a good thing to think about. So another tricky topic that comes up is food, right? So basically, if we think about the basics of food, right, is that the food that you use for the care of that you have for the care of the children that are enrolled in your program is fully deductible. There are two things that you need to keep in mind, all right? So children that in your care, their food costs are fully deductible. And there's a couple different ways that you can do that. However, if you're feeding meals to your staff, those are only 50% deductible. And if you're caring for your own children within your program, those costs are not deductible. But so just keep in mind, right? We know that the food for the children in our care is deductible. You just want to think about those two circumstances there. Now, when it comes to the food expense, there are two different methods that you can use. One is the actual expense method, and one is what's called the standard meal rate. So let's take a look first at actual expenses. So this allows you to deduct business expense of 100% of the actual cost of food consumed by your daycare recipients, right? So the children in your care, 100%. So keep that in mind. What this does require, the actual expense, is it requires a lot of documentation, and it is the only option available to centers. Now, home childcare providers can also utilize the actual expense method. That is certainly allowable for home care providers as well. What happens, however, is there is a large burden of documentation. So you're keeping track of all food costs, all the receipts. You actually want to keep a record of the children, when they were there. There's a lot of record keeping that you'll want to basically, the more information that you keep when you're talking about the actual food expense method, the better off you are. So you'll keep all of those receipts. A pro for that, right? A reason to do that is you get to include all of your expenses. So really dollar for dollar, if you're great at record keeping, down to the penny for the expenses that you had. Now, what's the con? There's a lot of record keeping in terms of this, right? There's a lot of recording that you have to do. So keep that in mind. The previous slide, we mentioned about the 50% for the employee meals, but keep in mind that if you were to have a party, if there is any food that is consumed by your employees during a party, that's not the same as feeding them a meal, day in and day out. So there are things, if there is a fringe benefit to a party or something of that situation there, you do not have to basically deduct only 50% of the cost of that. That would be an allowable food expense. Now, to simplify record keeping requirements, there's an optional standard meal and snack rate. Only family daycare providers, only home providers can use this, all right? So this is not an option that is available for centers, but it is an alternative to having to track the actual cost of food. Still has record keeping, all right? So basically what you do is you track the types of meals, the number of meals, and then you multiply that by a set amount. So the record keeping is easy. There's still record keeping to be done. So we do want to keep that in mind, but the record keeping, it's easier than the actual rate. Still record keeping to be done. You still need to have a method in which you're writing down the child's name, the dates of attendance, the numbers of meals, the types of meals. And basically what happens, what is the standard rate that we're talking about? So the CACFP program reimbursement rates are actually the tier 1 rate under the CACFP is what you use to calculate the standard rate for meals. And that's whether or not you participate in the CACFP program. The IRS uses the tier 1 rate for the CACFP. Under that, this allowable standard rate of using the standard rate of expense, you are allowed to expense 1 breakfast, 1 lunch, 1 dinner, and 3 snacks per child per day. Now, that's different than the actual CACF program. Those allowances are usually 2 meals and a snack, or 2 snacks and a meal. We have put, there is a link to the USDA.gov site where you, or the page on the site where you can look into the standard rate, taking a look at that tier 1 cost. So standard rate, less documentation than the actual, but still documentation to be had, but it is only available to family home child care providers. Well, that next tricky topic, home. All right, so to figure out how much of your expenses are considered to be business expenses and what percentage of those expenses can be deducted on your federal income tax, family child care providers use the time space calculation, right? So in time space, what we do is we look at space and we determine it in 1 or 2 ways. So it's either going to be a regular use space or an exclusive use space. So when it comes to time space, that's what we're keeping in mind for the space portion of time space. So what is regular use and exclusive use? Regular use are areas that are used all day or regularly throughout your business day, but they may also have another use outside of business hours. All right, so what does that mean? That's a space, an area that is used for your business, but is also used for your personal family life. So that there is considered to be regular use space. Exclusive use space is space that's only used for the child care program and nothing else. So let's just look at a couple of examples just to make sense of exclusive space and regular space there. So if we had a separate basement entrance only used by families of your child care business, we had a storage room that only contains toys and supplies for your business, those spaces are exclusive use spaces. There is nothing about those spaces that that you are having a personal benefit for you or your family, entirely used for the business. Now, exclusive use space is based on a percentage, exclusively, I'm so sorry, I just messed up there. So regular use space, right, would be something that was shared with your family and your business. So we want to take that into consideration. A regular use space would be if you have some bedrooms that you use during nap time for some of the children, but those are family bedrooms the rest of the time, right? That's a regular use space. If you use your living room a couple days a week for a specific instruction that you do a specific activity, but the rest of the time the family uses that room, those are regular use spaces. So when you think about costs that relate to exclusive use spaces, those are fully deductible. Basically, it's 100% for business. So that is a fully deductible space. Regular use space is deductible based on the space and the percentage of time that's used for the business. Versus the personal needs, right? So what's important with time space is that you properly document both types of use to justify the percentage that you're going to come up with. Something interesting with only child care providers, only businesses in the United States that actually have this ability to have a use of an expense for home and business. So it's very, very interesting. This time space really is created for home family child care providers. The IRS has the right to come in and measure your space. I've never heard of it happening, but they do have the right. So it's one of the reasons why we want to be very, very accurate in what we do, how we come up with these calculations.
Jennifer, we are at 25 more minutes, 6:05 right
now. Okay. I'm going to talk a little faster. Is that okay? I've got a little ways to go. I'll be careful there. So
okay, thank you.
Okay, I'm sorry about that. All right, so home costs can be fully or partially deductible. Costs for exclusive use areas are likely to be fully deductible. That could be if you're replacing tile in a basement that's only used for childcare, installing a childcare sized toilet, liability insurance, those are fully deductible. Expenses for regular space, common improvements, only partially deductible based on the business use percentage. So an example would be if we were replacing all the windows in the home, repaving the driveway, or even your homeowner's insurance. Those are things that impact the entire property that is also used for personal use. So those are regularly used areas, right? So that's where we use the time-space calculation. We'll talk about that in a second. I'm going to go through an example, but we'll go through I'll make sure that I don't take too long there. But when it comes to expenses for your home, remember for your home-based childcare business, is it directly supporting the business in 100%, or is it a general space, shared space, a general home improvement that would be partially deductible based on the time-space calculation? So I'll try to keep this short. Time, space, easy to deal with if we think about 6 simple steps. Determine the square footage of your regular use space. Measure all the space that is shared between home and business. Divide that number by your home's total square feet. That gives us 1%. Now we want to determine the amount of time that your home was used for childcare. So what you're going to do is you're going to add up all the hours that you were open. You divide that by 8,760. That's the total number of hours in a year. That gives you a percentage. You multiply that original space percentage by the time percentage. We come up with a number. We then measure all of the exclusive use space. We take that number, that amount, we divide that by the total square footage of the home. That gives us a percentage, and then we basically add those 2 percentages together. So we'll do a quick example. All right, let's say a home has 1,500 square feet. 500 square feet are exclusive use, 700 square feet are regular use. This provider is open 10 hours a day, spends an hour before setting up, spends an hour after cleaning up, closed 2 weeks during the year for vacation. All right, 700 square feet of regular use, 1,500 square feet for the whole home. Let's divide 700 by 1,500, 46.7%. I've got my first percentage. I'm going to now think about the time. That provider opened 12 hours a day, 5 days a week, 50 weeks, closed 2 weeks. That worked out to be 3,000 hours worked. Well, we're going to take 3,000. Let's divide that by the total number of hours in a year. 8,000.
Jennifer, I'm sorry, can we slow down again for the interpreters?
Okay. How are we doing on time? We're okay? All right. So
Yeah,
we'll
we
go
got
back.
20 more minutes.
Okay, thanks. I'll start over with this example. So we'll go there. So, all right. So for the example that we have here, as we referred to before, we've measured our regular use space. So we've measured the space that is used by home and business, and we came up with 700 square feet. So we're going to take that 700 square feet, we're going to divide it by the 1,500 square feet, which we said was the total amount of square footage of the home. That gave me a percent of 46.7%. Now we're going to put that percentage to the side. Now we're going to talk about time. So we saw that that provider is open 12 hours a day. There are 5 days in the week, 50 weeks in the year because they're closed 2 weeks out of the year. That's 3,000 hours worked. We take 3,000, we divide that by the total number of hours in a year, which is 8,760, and that gave us 34.2%. What we're going to do then is we're going to multiply those 2 percentages together. So 46.7 times 34.2, we're going to round up 16%. Remember, we had 500 square feet of exclusive space only used for the business, right? I'm going to take that 500 square feet, I'm going to divide it by 1,500 square feet, the total amount in the home. That gave me 33.3%. I add that 33.3 to the 16% that I came up with the time space calculation for regular use. My time space calculation for my childcare business is 49.3%. So time space is not difficult. A lot of people really think that it's mysterious. They think that it's something that's very difficult to calculate. I am going to suggest, if it's been a while since you measured out your time space, did the calculation, might be a good time to rethink it, go back, measure again. And a lot of times individuals don't take the time to think about changes in space. Maybe now there's a space that the family no longer uses. Okay, so now we could include that as exclusive use. And exclusive use basically raises our time space percentage that we're able to use for these shared expenses. So if you may even have a situation where a tax preparer has just kind of guessed at what your time space calculation actually was, what that percentage was. Take the time, go back. It's a good time to go back and take a look at that. You could be leaving some expenses on the table. All right, so stimulus funding. We are in a period where we did most likely, we know we received stimulus funding throughout the pandemic. And just so that you know, the general rule with the stimulus money is that you have to report it as income, but a lot of times the expenses that you spent that money on are deductible as tax, right? Deductible tax expenses. So what does that mean? Let's look at some timing, because timing is very, very key when it comes to your tax liability as far as stimulus funding is concerned. So let's take a look at 3 scenarios. All right, this first one, very straightforward. Let's say our business received $10,000 in stabilization money. That gets reported as revenue. In this example, they spent it on $10,000 in allowable expenses the same year. So nothing changes on the taxes. They received $10,000 in revenue. They spent $10,000 the same year, 0 tax liability. Now, if the business received $10,000 in funding, but they only had $5,000 in expenses in that tax year, right? They're going to have to pay taxes on the difference, which is $5,000. So just keep in mind, in that instance, right, our tax liability, our revenue went up $5,000 because we didn't have expenses to offset that. Now, one situation that this next scenario, keep in mind this does happen. So in this instance, the business received $10,000. But with a lot of the stabilization grants, we were able to attribute it to spending that happened in a previous year, right? So a lot of those stimulus funds, we received the funds in one year, but we were allowed to go back and use it, basically have taken the documentation for expenses from a previous year. So in this scenario, what does that look like? Well, we had $10,000 in revenue, but for this tax year, we didn't have any of those expenses. Those expenses came from 2022. What does that mean? We've got taxable income of $10,000. We're going to be paying taxes on the whole $10,000. We don't have expenses to offset that. So those are 3 common scenarios that happen with stimulus funding. All right. There are a few things that are important when in regard to taxes and the state of California. So let's just take a look at these here. All right, so you may be familiar with this, all right, and it is the ABC test for worker classification. This is in California. So the ABC test is a legal standard in California that's used to determine whether a worker is considered an employee or an independent contractor, right? So just so you know, this is more stringent than the federal laws. So it's very, very important to know about it if you have contractors, all right? So the ABC test outlines 3 criteria that apply to contractors, all right? Think of this and keep these in mind when we talk about contractors. All right, now, A, the hiring entity does not control or direct the work performed. That's the first criteria. So basically, that person the person doing the hiring does not control or direct the work performed. The work is outside of the course of the hiring entity's business. What is, so if we stop and we think about that criteria, okay, outside the usual course of the hiring entity's business. Think about that. And the third is if the worker is engaged in an independently established trade or business. So in the state of California, all three of those criteria are met. The worker is an independent contractor. But if any of those three aren't met, that implies that that is an employee and not a contractor, right? So that becomes a W-2 employee, not someone who is paid on a 1099. And California is very specific with this. And again, it is very different than the federal in terms of the regulation is far more strict than the federal. These are far stricter guidelines than federal. So you want to keep in mind that misclassification between an employee and a contractor can lead to legal and financial consequences, and it's crucial to assess worker relationships carefully. So that's quite a big deal in California. Now, in addition, California is a community property state, right? So income and property acquired during a marriage are generally considered joint property. So the implications for tax time are these. If you're filing jointly with your spouse, you should be able to combine income and deductions. We can take that all in there. But if you're filing separately, you need to divide the Schedule C income equally between both parties. So that is something in the state of California that may not be the case in other states. Something very important to keep in mind at tax time. All right. Now, in a couple of slides, we're going to talk about some rules that apply to California in regards to depreciation. Let's just look at a quick definition of depreciation, right? So depreciation is a special method that the IRS uses for deducting big expenses, which are those over $2,500. So with depreciation, there are times where you actually are going to have to deduct an expense over years, even if you paid it all in 1 year. So what does that mean? You may be paying more taxes than you anticipated, right? Because you expected to take that entire expense the same year that it was incurred, but maybe depreciation applies and the expense has to be spread out over several years. All right, so the rules of depreciation. There's one that is fantastic. It is called Section 179 depreciation. Basically, it allows for tangible property, right? We're talking about things, okay? So tangible property like office equipment, furniture, vehicles, assets that are not buildings and not improvements, such as if you have a home that's used for business, that is not something. We don't talk about assets under Section 179 like homes. So what's nice about this is that it actually allows you to deduct 100% of an expense up to $1.16 million. So in a lot of instances, Section 179 depreciation keeps you from having to expense something over the course of several years. It is something you'll want to talk to a tax preparer about, and you need to keep in mind that the item that we're talking about that you would apply to Section 179 has to be used for your business for at least 50% or more of the time. All right, so just keep that in mind when it comes to if you're a family home provider and you want to use Section 179 depreciation. The second type of depreciation is known as bonus depreciation. Bonus depreciation has been changing over the years. There is actually right now some legislation going on that may change that. At this point, basically what it allows you to do is it'll allow you to deduct 80% of certain assets in 1 year without an upper limit. But I can be honest and say that Section 179 works for most businesses better than bonus depreciation. We're going to talk about bonus depreciation in regards to California in a second. But just keep in mind that with bonus depreciation, it only would come into play if the item has a useful life of 20 years or less. So keep that in mind. But given the fact that Section 179 depreciation works so well for so many things, we may want to consider that before bonus depreciation as far as our federal taxes are concerned. Separate rule for vehicles with Section 179. Vehicles are a little, bonus depreciation is a little more favorable for vehicles. So for actual items, we might want to think of Section 179. For vehicles, we might want to think of bonus depreciation on our federal taxes. The other rule is called safe harbor for small taxpayers. That is about improvements to a business that are either less than $10,000 or less than 2,000 or 2% or less of the unadjusted basis of a property. That's the value of a property minus the land value. So my suggestion with depreciation is that you really do speak to a tax professional regarding depreciation. There are rules that you may not have to depreciate something over the course of many years. Now, what is very important in California? California does not recognize the federal bonus depreciation method. So Section 179 would be a better option. Not an issue with most child care providers and the fact that Section 179 for physical things up to $1.16 million. So you would need really, really substantial depreciation, really a substantial purchase, a substantial cost of an item, to not have to use or not be able to use 179 in California. But again, speak to your tax preparer. Perhaps you did have costs because bonus depreciation is not an allowable means of depreciation in California. It could have some tax liabilities there. All right, how your taxes are calculated and paid in California. Estimated income tax is something that you need to think about. Sole proprietors and partners. It is a recommended practice for federal taxes, but California small businesses should be aware that state income taxes are not typically withheld. All right, so if this applies to you, quarterly payment of estimated income taxes is crucial to avoid penalties, right? So if you don't have a recommendation for the percentage from tax software or professional, we recommend on the state level paying estimated taxes of 4% of your overall revenue. All right. So there is also, we've got quite a few things in California that don't exist elsewhere. So there is a minimum franchise tax for LLCs and corporations in California. These businesses are subject to that minimum franchise tax, that's hard to say, of $800 regardless of your income. That annual tax is structured as a flat fee and is due even if the business didn't have any profit that year. So similar to other tax payments, this failure to pay this minimum franchise tax on time could lead to penalties. All right. Now, this may not apply to many people here tonight, but there are franchise tax rules that apply to businesses with a profit, not revenue, but a profit of over $250,000. You can go to the CaliforniaRegisteredAgent.com and look for that, the rules regarding that situation there. And in California, there's an additional rule for S Corps and C Corps. So there is a 1.5% tax on revenue for S Corps and C Corps, although no franchise fee. LLCs that are treated as S Corps or C Corps do pay that tax. So that's something that if you go to taxes.ca.gov, you can see all of those tax rules for California. All right, where can I get my taxes prepared? How should I get my taxes prepared? All right, I know we're coming up on it. We're gonna run through this. I apologize to our interpreters here. So really, we've got two options. We can pay a preparer. They guide us along the way. They could be expensive, but they also could provide support. Fantastic. If we choose to do taxes ourselves, It's possible, it's less expensive. We may have to pay for a guide if we need additional support. They actually, though, can be more accurate, which seems a little crazy, right? But sometimes tax software can be more accurate. So we have those options there. If we choose to go with a paid preparer, we want to find out, are they qualified? Have they received training? Have they worked with childcare businesses, right? Do they understand your needs? We want to make sure that they have been working with childcare businesses. Sometimes it's really, really hard to find a really experienced tax professional who works with childcare providers, especially if you're a home family-based provider there. We want to make sure that they've had training. We want to make sure, ask about certification. Will they also be available after the tax season if you need advice or help? And something that's very important, can you get a copy of your return? So you are entitled to a physical copy of your tax return, plus all of the documents and receipts that you gave them should be coming back to you. So just keep that in mind. You're entitled to that. You'll want to have it. You'll always want to hold on to your tax returns. All right, now if you decide that you would like to do your own taxes, there are online tax guides available to help you. We happen to have here a QR code. This is for the TurboTax Self-Employed Online Tax Preparation Guide for Childcare Businesses. Interpreters, I'm sorry, I apologize. So basically, you can use this QR code. All right, it will allow you to access a TurboTax guide for childcare providers. We're going to be putting the link in there in the chat. There's also a link that will give you some other tools about stimulus funding, managing finances, business operations. These are free and easy tools. So keep those in mind there. Here's another lengthy, it's called the Confidence in Quality Tax Rubric app. And it was based on working with actual family and center providers, looking at their tax returns. It's designed for sole proprietors and LLCs that are single members. So basically, anyone who reports their income on a Schedule C and files with their 1040, but there are still benefits for that app, which again, the QR code is here. There are still benefits for S corporations or I should say LLCs that declare themselves as S corporations or C corporations. Some of the lines don't match up the line numbers, but you can still use that. So I would recommend, taking a look at this, using this QR code to take a look there. So lots of tools. But now we are here to the questions, and I know that we need you to hang out to the end because Chris is going to speak with you after questions. I know we're running right till 9:30 here on the East Coast. So do we have any questions? Is there anything that I can help?
We do, Jennifer. Thank you so much. This is Chris from LIIF. Take a breather, take a breath, a drink of water.
I'm gonna drink some soda, Chris. How bad
There you
is that?
go. There you go. I realize we're very close to time, folks, but if you're able to stick around, I'll jump into the Q&A and ask some of the questions for Civitas to answer live. Obviously, we have a lot of interest, and we'll try to get to as many as we can, but we'll be sure to download all the questions and see if we can have them answered for you offline. So, Jennifer, one of the questions I'm seeing a lot in the Q&A, many participants on tonight's call received grant funding for infrastructure improvements to their facility through ARPA funding.
Yeah.
And as a result, they were issued a 1099-G for those funds.
Mm-hmm.
Where should they report a 1099-G for grant money? Is that just on the Schedule C or somewhere else?
Yeah, it's actually on the Schedule C and it's included in your revenue. So when that very first line on your Schedule C, that's all the revenue, including the 1099s that you receive, all of the 1099s. So that's going to go on that very first income line of the Schedule C.
Fantastic, thank you. The next question is, I think very early on you mentioned that what might be some examples of expenses that are not ordinary and necessary and might trigger an audit?
So things like that, it often will not be the case with centers, right? Centers that are businesses that are not based in the home. That was often the case, that those would be 100%. In terms of expenses, when we talk about the home businesses, you have to kind of keep in mind that perhaps you have a cable bill and the children do not watch television. That's a little bit debatable, right? Oh, well, we've got the TV. Should we use use the family home, use of the business use of home, I should say. You could have something like that not allowable, right? Not deductible. So it's really stopping and thinking about things that are required for business, not nice to have. Now, if you can justify using this within your childcare business, that you have the documentation, you need to be able to stand firm on the reasons that you use it, the reasons that you expense it, why it's necessary for your business. But as a home provider, look at it expense by expense and say, is this required for my business? Is it a must-have, not a nice to have? So there are a lot of different examples that could apply, Chris, but it's really thinking about that definition. It has to legitimately be of use in your business, and they consider it to be necessary for your business. We know there are things that are perhaps there's educational things that you don't have to have, but boy, they do play a great role. That's an allowable expense, right? But just keep in mind, and I think for home care providers, we just need to be very cognizant of what is necessary for our business.
Great, thank you. The next one I'm seeing here is if we received an employee retention tax credit, should we enter or report that as income?
It is income, so I know it sounds a little odd, okay, in the fact that that's labeled as a credit, but it is income, it is revenue, and you are going to have to pay taxes on it. I'm going to go off on a quick tangent. ERTC credits are now being audited more than ever, even if you had already received checks. I happen to be the person that speaks on ERTC at Civitas. If you used one of those predatory companies that charged you a 15, 20, 25% fee in return for doing your calculations, take a moment, look back on the rules of ERTC. Unfortunately, a lot of those companies kind of messed with the rules, oversimplified things, and now businesses across the United States are being audited. There is something that's called Voluntary Disclosure Program, VDP. And what that's allowing is the IRS is saying, hey, up until March 22nd of this year, if you had received a ERTC credits, if you received checks, if you cash those checks, you go back and you realize, hey, maybe I wasn't allowed. You actually can repay that money with no penalty, with only having to repay 80% of the credit. So ERTC, if you are in the right, if it was due to a true revenue reduction, or if there was a true government order that's partially or fully suspended your business, you're in the clear, right? If not, you may want to take a look at the VDP program, because we would certainly want you to take advantage of being able to receive the benefit of that 20% savings if the IRS were to come back and audit you. ERTC, #1 audited topic at the IRS right now.
Very helpful to know. I'm going to pass it to my colleague Ivan, who has a couple questions that he would like to ask as well.
Sure.
Hi, Jen. So these are some of the questions that were submitted via Spanish, but I've already interpreted them in English. So one of our grantees, name is, I believe, Leo Vijalda, is asking, I have a person who helps me with my childcare. She asked me for a W-9 form to report, so she can report on her taxes, but I cannot give that form. Is there a way that I can suggest something we can suggest to give to her helper?
I don't know. I'm so sorry, Leo. Is it possible, Chris, could we follow up after, if we could get that question in writing, and I can go back to Gary and we can try to get some information on that?
Absolutely.
I apologize. We never guess. If I don't know the answer, we're going to find it out for you, but I will not guess. I want to get you taxes we don't mess with, right? So we make sure it's the 100% right answer.
Okay.
Yes, we will absolutely get that over to you.
Thank you.
And another question I had was, from Ms. Gallardo is I take child development classes, and every time I go, and also purchase food, can I put any of those business expenses towards their taxes, or where can they put that towards?
Yep, so on your Schedule C, there is a line for business meals. That is where the food that you consume during conferences, at conferences, for any type of business travel, during any type of business travel, for any type of continuing education, any type of meetings, any meals, that actually goes under business meals on your Schedule C. The travel portion of that, you're going to decide what method you are going to use in terms of expensing transportation costs. Is it going to be the actual where you're saving all of the receipts, or are you going to use the IRS standard mileage rate? So those will basically be considered. You'll see on the Schedule C, there's the vehicle and the transportation expense line that you would put that in. So those two will end up being separate, but you are entitled to both of those as legitimate business expenses.
Thank you.
Thank you. I think we'll reserve a few minutes for a minute or two for a couple more questions, and then we might wrap up. Jennifer, the next question is about homes that I do not live in and where I only run childcare from it. Do repairs through things like my driveway, roofs, exterior paint, et cetera, qualify as deductible at 100%?
They do, if you can prove that that's only you'll want to make sure all your documentation is there and that you can prove that it's only used for your childcare business. And if that is the case, any allowable expense on your taxes would end up being 100%. And we do know that driveway repairs and such are, if that is 100% used for childcare, then it is 100% of an allowable expense. Keep in mind, depreciation may apply, right? Depending on how much that is. I would certainly say if you have any major improvements, depreciation may apply. If you have a repair, those items do not need to be depreciated. I always recommend involving a tax preparer when it comes to depreciation.
Fantastic. And then the last thing I wanted to ask, there was a lot of interest and questions regarding time space percentages. I think that slide you showed was really, really important. Did you have any resources at the ready that maybe speak to that directly, or any of the resources you shared in the chat? Do they speak to anything about time space percentages?
The great thing is the homegrown guide, right? What we started off really, really early, has a beautiful section on time space. I'm going to also just, Chris, if you don't mind, I'm just going to advance 2 slides. This here is the Civitas Strategies YouTube channel, and we have videos on the YouTube channel about time space. And it will walk you through all 6 steps that we did. Don't be intimidated by time space. It's not difficult. The initial measuring and the thinking about exclusive versus regular use space, okay, we've got to kind of put our thinking caps on and think about that. But go to our YouTube channel, look at those videos. They are there. You can stop them, take notes, play them over again, and really get an understanding. And they're there in English and in Spanish.
That is fantastic. Thank you so much. It's clear that a topic as important and intense as taxes needs more than an hour and a half. But I want to thank you again for the partnership and for this learning event. And again, we'll be sure to download all the questions that we did not get to, and we know that there's a lot. Again, thank you all for attending. I realize it's been a long day, so we really do appreciate you taking the time out of your busy day to be with us and learn more about taxes in your childcare business. In order for us to continue planning and putting on really helpful webinars such as this, we would greatly appreciate your feedback. So if you wouldn't mind, please take a few minutes to fill out the online survey that will be available to you. Leslie, remind me, is that going to be in the chat or?
Yes, I'm going to put it in the chat, but I also have a QR code to share.
Okay, thank you so much.
Should I stop sharing my screen, Leslie?
Yes, please.
Mm-hmm.
Thank you.
You're welcome.